everyone, and welcome to Talk ETFs. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. My guest today has a talent for breaking down market movements in a really clear and concise way. He's Brian Jacobsen, a Senior Investment Strategist for Allspring Global Investments. We're going to talk about the Fed, about inflation, and about the economy, so stick around for all of that. Brian, welcome to the show.
Thanks for having me. Really appreciate it.
Brian, I want to ask you about the macro outlook because things have gotten pretty confusing. We had 3 months in a row where it seemed like inflation was on the downswing. Then we got the latest numbers for January and it looks like inflation bumped back up. Is that a concern for you?
You know, it is a concern because anytime you get the macro data, and we know that the Fed is watching it, a lot of the Fed officials have talked about wanting to see maybe 6 months in a row of improvement. And so if you have 3 months of improvement and then a step back, it's like, does this reset the clock for them? I actually think that the inflation data was more of a bump in the road as opposed to a change in the trend. There are a lot of weird things going on with the report, probably the result of seasonal adjustments. You had things like, used car prices. According to the Bureau of Labor Statistics, those went down, but according to wholesale prices, those went up. Natural gas prices went down, but the Bureau of Labor Statistics said they went up. So there's all sorts of kind of weird dynamics there. And I would not be surprised if when we get the February data, which won't come out until March, that it actually shows a bit of a reversal going back towards that disinflationary trend.
Another thing that's caught investors off guard, Brian, is the strength of the US economy. Heading into 2023, it almost seemed like there was a consensus that the US economy would fall into a recession. Yet a couple of weeks ago, we got that super strong jobs report, which showed that the unemployment rate fell to something like a 5-decade low. What's going on with that?
I think that it shows that we probably had a bit of a roving recession, is what I would call it, where it wasn't like this synchronized downturn. We know that housing has had negative growth for like 7 quarters in a row. Structures spending by businesses and equipment spending by businesses has been negative like 3 out of the last 4 quarters. We also know that durable goods spending by households has been declining on a fairly steady basis. And so there's all these like classic hallmarks of it having been a recession, but it's been really supported by strong services spending because people are still shifting back away from spending on goods towards services, inventory investment, and then also exports. So to me, it's a bit of a shaky foundation for really sustained growth still going forward, which is why I think we might get a synchronized downturn, but fairly mild. So a lot of the economic damage has already been done, and I think is evident in those areas like housing, spending on autos, things like that, but it isn't showing up in the labor market. We had a jobless recovery coming out of the global financial crisis. We might have a job full recession as we deal with the full weight of Fed rate hikes.
If you combine everything you talked about, Brian, from the jobs market to inflation, what does that mean for Fed policy? Are we close to the end of the Fed's rate hiking cycle, or could we potentially see the Fed funds rate move up to 6%?
I think that would be a very unlikely event that they would need to get to 6%. I never want to say never because, I don't know what the data will be. I do have what I think is an educated guess as to what the data might show. And as long as we have that the January data for inflation was just a speed bump in the road as opposed to a change in the direction for inflation, I actually think the Fed could probably get up to maybe 5, maybe 5.25%. And then they'll say that, this is good enough. Inflation is coming down. Job market is staying strong. We can take this as a win, right? We don't need to see the unemployment rate actually go up in order to declare victory. Maybe they can just kind of take the win here, which is that they haven't done a lot of damage to the jobs market, and they have indeed turned the tide for the direction for inflation.
Ryan, I want to turn to the stock market. Even though we have seen interest rates tick up a bit to start the year, the stock market's performed pretty well. Is that a surprise for you?
The end is near for rate hikes, and that is typically a fairly bullish sign for stocks and for bonds. In the last five rate hiking cycles that we've had since 1989, the equity markets were up when the Fed actually hit pause with rate hikes. So they hiked and then they held. And during that holding pattern, that was a time that 4 out of 5 times the S&P 500 was up. 5 out of 5 times the bond market was up because a lot of the damage was done during the hiking phase of the cycle. So once they hit pause, that was typically a time in which people could kind of adapt and properly adjust their expectations for the future, and you could get a bit more traction for risk assets.
So